and, well, just letting me know you can hear me. Just give me a big old yes. Yes, yes, yes. Thank you, Alex. Thank you, Howard. Thank you, Mike. Thank you, Merrick. Thank you, Sheldon. Thank you, Bob. Good morning to you. Thank you, Fawn. Thank you, Steve. Thank you, Thomas. Thank you. Justin is back. All right. Thank you, Sandra. Shane is back. Thank you, Shane. All right. So today we are going to be talking about something near and dear to my heart. And I hope yours too. If not yet, maybe after this webinar, it will be. We're going to be talking about long-term buy rights to maximize investment capital. Ooh, that's a good one. This is a really good one. Now, before we get started, I want to point out that options are not for everyone, and you should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything that we are doing here is providing generalized information, not specific to your situation. Now, I see a lot of old friends here, but I see some new friends here too. So, for those of you who are not familiar with me, who I am, what I do, why maybe you should listen to me, allow me to introduce myself. My name is Dan Passarelli, and I am an author of two of the most popular option trading books. Trading Option Greeks is the one I'm most known for. It's been called the Bible of the Greeks, been rated in the top 5 options books ever written, which I am very, very honored about. And hey, I'm working on my third one too. Oh my goodness. You know what my third one's about? My third one is about the exact topic we're talking about today. Covered calls, cash secured puts, long-term buy rights, and all the stuff that goes along with it. So I've got some really great things to talk about today. Now, I'm also a trader and investor, traded professionally down on the floor of the Chicago Board Options Exchange, CME Group, Chicago Board of Trade, traded upstairs in like a hedge fund type account. Now I trade in a retail brokerage account just like you. And another thing is I am the founder of Market Taker Mentoring, which is the global leader in option trader education. Did you know that? Yeah. We have traders in over 50 countries. Pretty crazy, isn't it? We've put tens of thousands of people through our training. If we include all the free trainings we do, we're in the 6 figures of how many people we've trained. And I am a trading industry collaborator. I work with lots of the great options-friendly brokerage firms out there, like Firstrade, for example, and others, and also pretty much all of the options exchanges globally. Been to most of them and collaborated in some way with maybe all of them. And I'm a family man. Got my wife, Kathleen, who those of you who are Market Taker students, you know Kathleen. She helps you with whatever you need. She runs operations here at Market Taker. And I have my 2 adult children who are back in the nest. The nest is no longer empty, but you know, they're just here for a short time as they go through grad school and medical school. And I got my 2 cute little dogs, one of which always sleeps behind me all day long. And I am a runner, a foodie, traveler, musician, come from a musical family, blah, blah, blah. That's me. Now, let's talk about the important person here. Let's talk about you. And let's talk about some resources for you. Because today we're going to talk about long-term buy rights. But afterwards, you might have more questions, more thoughts. Well, I have a podcast that is all on exactly all of this. It's called Wealth Building with Options. And if you go to any podcast platform that has ever been invented, you ought to be able to find it. That includes Apple Podcasts, Spotify, YouTube, Google, all of them, any podcast platform. That podcast will help you master covered calls and cash secured puts. A buy right is kind of like covered call. We'll talk about that in a minute. So it's really great for real investors of all experience levels. It will help you with adjustments, the right mindset for it, strike selection, expiration selection, analysis, management, everything, the whole shebang. We've had 20 episodes already. In fact, I think our 20th just dropped this morning. Like I said, new episodes weekly. They drop every Tuesday morning. So please make sure to check it out after this because it is free. And again, just search Wealth Building with Options on any platform. That doesn't make any sense. Podcast platform. Okay, so let's jump into long-term buy rights. So you've probably heard about covered calls. You probably heard the term covered calls, and you probably heard the term buy rights. So they're different things. Sometimes people use them synonymously, but they're not. They're constructed differently, and they're constructed differently typically for a reason. I mean, if you're doing it right, it's for a reason. Covered calls is when an investor, and by the way, I'm kind of separating out in my mind, in my words, investor and trader. They're two different people. Now, you can be both, but they're two different things. Trader is what a lot of the webinars we do here at Firstrade are all about, trading. But investing is what some of the webinars we do here at Firstrade are. Investing is more long-term, growth-oriented. And trading is shorter term, just taking money out of the market from a systematic methodology. So covered calls is when an investor owns a stock and then sells short a call on that stock. They overwrite a call. Again, it's an investor-oriented strategy because the main thing is that you own the stock, but you're trying to eke a little bit more out of that stock, which is great, right? Is anybody here as an investor, not a trader, but as an investor, own stocks for their dividends? Type the letter D in the Q&A box if you own stocks to get dividends, if that's part of your strategy. Justin, D. Howard, dividends, D. Baron, D. Shane, also does dividends. Vince, Madeline. So those stocks that you own to collect dividends, man, you know what? You hope those stocks go up. But if they don't, that's okay because you're still making the dividend, right? Well, covered calls and buy rates for that matter, it's kind of the same thing. Yeah, you hope they go up. If they don't, well, you know what? You're still making money from them. So it's generally considered a conservative investor strategy. Now, buy rates are very similar. That is when I buy a stock and at the same time sell short a call. So basically, here's the big difference. Covered calls, it's 2 trades. Buy rates, it's 1 trade. We can call it a spread if we're feeling, frisky. They're both investor-oriented strategies, generally considered conservative investor strategies. Now, the data for either of these things, there's data on both of them, show that they're both very beneficial to investors and can outperform simply owning the stock outright. Because look, the buy and hold strategy, that is a proven thing, man. But we like to outperform the market, right? Buy and hold strategy assumes no slippage, no commissions, no bid ask spread, no taxes, all that business. But you're going to have slippage as an individual investor. You're going to underperform what the numbers say you should. So we don't like to underperform. We like to outperform. And that is exactly what we can do with these while lowering risk. Risk in trading is measured by standard deviation. So constructing a covered call or a buy right. Actually, I'm going to change this. Hold on a second. This is like my favorite thing about doing presentations like this. If I decide at the last minute, let's change the words here. I just changed the words. So let's narrow in here and jump right to it. Let's narrow in on constructing a buy right. Let's say we want to buy a steadily rising stock. So we're not talking some to the moon Palantir, something like that. We're talking about a nice, wonderful, boring but stock. All right. Boring, boring, boring. Like, here, hold on a second. Hold on a second. I'm going to show you a picture of one. You want to see a picture of one? I'm going to show you a picture of one. Oh, yeah, I'm going to show you. Hold on. There she is. Ain't she a beauty? Look at Verizon over the since the beginning of the year. Isn't this like an awesome stock chart to look at? Oh my gosh. This is the most boring stock chart you'll ever want to look at. I'd rather watch paint dry. This is boring. This is a perfect stock for a buy right or a covered call. So, okay. We'll get back to that in a minute. We want to buy one of those. We think it's going to rise some. Not a lot, but some. Yeah, we can drill down a whole bunch on that, Madeline. Wait, Madeline or Madeline? You can give me like a capital I for Ein, little I for in. Lynn, Madeline. Oh, thank you. That helps. Yeah, so Madeline, that's a good discussion. I went back and forth. Well, I haven't gone back and forth. They're very similar fundamentally, but let's look at it. Madeline says, oh, maybe AT&T is better. Maybe it is. Let's take a look. Oops. It is a little more leaning upwards, isn't it? Um, yeah, you know what? AT&T is probably a better example for what I said here. I just think from a fundamental standpoint, Verizon might be a little better value, but I think for what we're talking about here, this is probably a better example. You're right. Oh, except for one thing. I like only doing, and this is not, I don't think this is in my PowerPoint here. So if you're taking notes, write this down. A lot, not always, but a lot of times covered calls and regular buy rights are better when stocks are above $30 a share. The long-term buy rights I'm okay with. So, man, like you brought up like such a great little discussion point without even trying, I think. Kind of accidentally. There's a lot I want to talk about that. How do I get this darn thing off the screen? Come on, man. Ooh. Oh, wow, that was crazy. There we go. That's what I wanted to do. Okay. So when you buy anything, I have a question. Would you rather pay more for this thing or less for this thing? Less, right? Whenever you buy anything, you'd rather pay less. And when we get into value investing, that's part of it. And, you know, we'll talk a little bit, we'll sprinkle in some value investing concepts as we go through this. Okay. So we want to pay less for the stock than the market wants to give us. Yeah, man. Who doesn't? That sounds like a pretty square deal, man. We also want to have less risk. This is like my Christmas list over here. I like this stock, but I don't want to pay that much for it. I like this stock, but I want to have less risk. Wow. How do we do all that? Well, there's always a little bit of a trade off involved. The trade off here is we can only do it on stocks like AT&T. That has been pretty darn boring lately, at least since, you know, the April low craziness here. Pretty darn boring, just climbing, bing, 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 bing. Right? So we're only really allowed to do it on stocks like that. Some stock that we expect a huge breakout up to the upside, don't those, it just doesn't work on those. So this is only really for certain opportunities. So let's look at just the really, let's look at, well, let's look at this. If you're going to love this, if we were to sell, so look at AT&T, right? AT&T today, right now, is trading at $28.94. Let's say we go to AT&T's option chain, and we look at the options that expire in about a week and a half, 10 days from now. Where I say this thing is trading right now, it's at 28.78. So we sell the 29 calls. I mean, geez, that's only like less than 25 cents out of the money. I can only get 22 cents for them. This is because it's like such a cheap stock. It's below 30 bucks. Even the $30 ones are tough. So I don't really like that. If I want to give it enough room to run for the, but it doesn't really move that much, right? So in 10 days, well, it's not like I think it's going to go to 31, not a stock like this. But what if I go out further in time, maybe like 45 days, month and a half? Well, now I can sell the 30 calls at like 45 cents. Oh boy, it starts to get a little better. What if I go out to 108 days? Oh my gosh, I can sell like the 31 calls. I can give it a lot more room to run. I can sell those at 60 cents. That's 3% of the stock price. Wait, 3%? Yeah. No, it's like 2 point something percent, which is not really that much if you think about it over 108 days. It's like less than 6% extra a year. You'd have to sell the 30s. Now that's sort of starting to get interesting. That's maybe like 8% a year or something. But it's definitely better when we go out further. We can take in more option premium. Okay, so hold that thought now, friends. So let's just go with a regular example here. There's this stock, I want to buy it. It's got a nice little chart that looks like AT&T's. We buy 100 shares at $70 and sell the January of next year. So we're talking over 6 months or 6 months or so. 72 and a half calls at $8.20. Now you might look at that and say, geez, I don't know. I trade covered calls. I like to give it more room to run. Room to run means sell a higher strike so that the stock can make money on the shares before getting called away and giving up upside. Yeah, I like to give it more room to run, Dan. That's okay, but it can be a little bit different with long-term buy rates. And so let's take a look at that. If we buy 100 shares at 70 and sell this 6 month 72 and a half call with not a lot of room to run, our actual break even ends up being a lot higher because of the big premium we take. So this is more than just buying the stock. We're going to get a higher annualized return, which I'll show you how to do that. And we're going to have a lot of cushion to protect ourselves to the downside. So, okay, buy 100 shares at 70, sell a 72 and a half call at 820. If the stock is above, anywhere above 72 and a half at expiration, I make $10.70. $10.70. So 10.7 divided by 70, that's where I bought the stock. That's 15% in 6 months. Well, if I were to annualize that, there's 2 6-month periods in a 12-month period, right? In a year. So that ends up being 30% a year annualized return. And remember, this is a boring old stock. And remember, we're not giving it room to run to the upside. We're mentally swapping out how much we want to make on the stock going up with how much we can take in option premium. Okay, so we can make 30% annualized return. Geez, that's pretty good. I mean, would you be happy making 30% annualized return on all your stock investments? Yeah, I would. Well, this is a way to potentially take a really boring old stock that, best case scenario, you hope to make 5% in a year, 7%, and massively improving that. But what if we're wrong? What if it goes down? Well, if it goes down, my break even for the stock, which is my cost basis, not for taxes, but for, mentally thinking about what price do I really own the stock, because I really own the stock at 70, but I get to keep that $8.20 no matter what. So how much did I pay? I paid $70 a share. How much did I collect? $8.20 a share. Net, I paid out $61.80. So as long as the stock is above $6.81, got to take a note myself. I hope you're taking notes. As long as, like 6 months from now, as long as the stock is above $61.80, I make money on the trade. So basically, I get $8.20 of cushion divided by $70 stock price. The stock can go down 11.7%, and I still make money. This sounds pretty darn good. This sounds kind of really darn good. Best case scenario, I make 30%. Worst case scenario, even if it goes down 11%, I'm still making money. I mean, don't get me wrong, stock can go to zero, and that'll happen. You can do all the research in the world, find the best stocks that you can, and some of them are still going to go to, some of them are still not going to work out. But you get extra cushion on every stock you do this on. You can be 11.7% wrong and still make money. Well, what's the problem with this strategy? Well, let's take a look here. So, not really much. Hold on a second. Oh, yeah. How about the static return? Let's take a look at that for a second. Oops. How about the static return? What if the stock just stays at 70? Because let's think about this for a second. Many of you are options people. What is one of the assumptions of the options pricing model? Well, it's that stocks adhere to a log normal probability distribution, specifically log normal with leptokurtotic tails, right? This is, if you're not an options person, that might just not mean anything to you, and that's fine. It just means on average, stocks make little moves, and every once in a while they make really big moves. So, I mean, the most likely scenario is this stock is probably close to 70 or just a little bit higher at expiration. That's what the probability distribution tells us. So what if it stays right at 70? Well, if it stays right at 70, I still get to keep the $8.20. I still make $11. I still make 11.7% in 6 months, and annualized, that's 23.4%. What is even wrong with this trade? Kind of not a lot. I mean, sure, if this stock goes up 50%, you left money on the table. If the stock goes down 50%, well, you lose. But you're specifically choosing a stock that you don't think is going up 50% and that you don't think is going to fall 50%. So the more skill you have fundamentally and technically, the better off you are. But this just gives you extra cushion to be wrong if you're wrong. But Baron takes up a very good question here. How do we incorporate specifically the ex-dividend date while selecting strike and days to expiration? Right. So let's back up for a second here. What if, like AT&T, the stock pays pretty good dividend? I haven't calculated it for a while in AT&T. What is it? Maybe Madeline knows. Is it 7%, 6% or something like that right about now? I own some AT&T. I look at it and calculate the dividend yield often, but I just haven't in a bit. 3.8%? No, it's got to be more than that. I think it's got to be more than that. Well, let's take a look because this is a big part of your question here, right? Hold on a second. AT&T dividend. What is this? Google Finance. Quarter. Oh gosh, it's Baron, you're right. It's only 3.86%. This is why I've sold close to the money covered calls because I've owned the stock. I've owned the stock for years because the dividend is not as attractive as it was back when the stock was at 27. I actually want to sell calls to take in more premium and want them to get assigned. Man, I mean, it was, it was when the stock was at 27. Because remember, the dividend yield is you take the dividends paid every quarter, so all 4 quarters of the year, add them together, divide it by the stock price. That's your dividend yield. So the lower the stock price, the better the yield. Anyway, so here's one of the questions here. What if you want to keep that dividend yield? Maybe you bought the stock a little bit lower. When you bought it, it was a better yield, and you technically still get that yield, and you think maybe the stock will come down, so you're not going to sell it now. You're just going to hold it and keep that dividend yield. You want to get the dividends. Okay. Well, if I sell calls on it, here's what happens. When I sell a call, I sell it to another human being. Or, I mean, really, it's to a market maker. So it's debatable. Are they human beings? I don't know. But I do sell it to another biological human. And they, in contrast, own that call. Now, here's the deal. They are not going to collect the dividend if they own the call. You, owning the stock and being short the call, will get the dividend. But market maker are greedy. They're sinister. They're smart. Not really greedy and sinister. They're just smart. They know, hey, if I own the call, I don't get the dividend. If I own the stock, I will get the dividend. So what they're going to do is they're going to say, well, if the calls are in the money, I can exercise the call and own the stock. There's kind of more to the story, though. When market makers own the calls, they offset the delta of their position. They trade delta neutral. So they short the stock. So not only do they not get the dividend for being long the call, but they actually have to pay the dividend because they're short the stock. Did you know that? Maybe you didn't know that. If you are short stock and it's the ex dividend date, you have to pay the dividend. Crazy, right? So market makers don't want to do that. So they do a little bit of math the day before the ex dividend date. And in AT&T anyway, Barron shows that the ex dividend date is July 10th, apparently. So the day before July 10th, market makers are going to say, all right, hold on a second. I'm long these calls and I'm short stock against it. Now, market makers, when they're short stock, they have these sweet deals with their clearing firms and such. When they're short stock, they actually get paid interest on the money that they collect on the stock. Or, well, when you sell stock short, you get money put into your account. And so market makers earn interest on that money that's in their account. Technically, they call that a short stock rebate, but it's, it's just interest. So the market makers are going to say, okay, hold on, wait. If I don't exercise this call, I'm going to get this much interest on the stock I'm short. Maybe that comes out to, 30 cents a share. But if I do exercise, and I throw away the time premium on the call I'm long, right? Which has value. I mean, if I'm long a call in short stock, it's effectively like being long a put. So they don't want to get rid of their synthetic put, right? But if they make more on getting the dividend, then they give up on the time premium of the call or the synthetic put, plus the interest they get on the short stock. If they make more on the dividend, they're going to exercise the call. And then you're going to lose your long stock because you're short the call, they exercise it. So you have to fulfill your obligation to sell your shares of stock. That's the whole deal that you make with a covered call or a buy right. So the original question was, how do you incorporate the ex-dividend date while selecting the price? You can do some math in a similar nature to what I just described, or you can just say, hey, if my calls are pretty deep in the money and there's not a lot of time value left, I'm probably going to have to sell my stock. So when you go out 6 months in time, right? Because this is a long-term buy, right? When you go out 6 months in time and you start out selling either an at the money or a slightly out of the money call, you've got a bit of a head start. There's going to be a lot of time premium, and so they're probably not going to exercise. If it's out of the money, they're not going to exercise. If it's at the money, they're not going to exercise. But if I sold this call a month ago and the stock has gone up and now that call's pretty deep in the money and there's not a lot of time premium, they might exercise. So in that case, what you would want to do is probably close the call or roll it up to a higher strike where there's more time premium and they're less likely to want to exercise. I wouldn't for a short-term buy rate or covered call, I would definitely plan it around the ex-dividend date. For a long-term buy rate or covered call, you can't. It just doesn't make any sense. As it gets less and less time to expiration, it becomes more and more of a potential issue. Very, very, very good question. Could you roll? Oh, Bob. Hey, Bob. Could you roll the call option if the stock price increases. Yep. Okay. Bob is a step ahead of me. Excellent. I love it. Thank you, Bob. Okay. So basically, if the stock rises through the strike price by expiration, I make $2.50 on the stock plus $8.20 on the option. That's $10.70. It's 15.3 annualized. No, it's 15.3% return before you analyze it. It's let's change that. 30.6 annualized return. So the bad news is you could lose money on the table, but it would have to go up massively to leave money on the table. And there's two key discussion points here. One is you're only doing this on stocks that you think is not going to go up more than 30%. But the other part of that is you can be wrong, and you do this enough and you will be wrong. There will be some stocks that go up way more. I just had that. I just got assigned on one. I think it was this past expiration where it just went up way, way more. Okay, that's fine. But you still make 30.6%. But you might say, but Dan, I could have made 50%. And you're right. And that stings, but this is never about doing this once. This is about trading covered calls, buy rights, over and over and over again, doing this hundreds of times throughout your investing life. So for every one that way outperforms and you leave a bunch of money on the table, there's going to be 20 that didn't. And so in the long run, if you add them up together, like you take into account, oh, this one I left money on the table, missed out on 20%. And oh, these 20, I made 30%, where if I just held the stock, I only would have made 8%. Or this stock went down and I would have lost 5%, but I actually made 5%. And then there's going to be some where, oh, the stock went down 25%. No, but I had 11.7% cushion. I actually only lost, 14%. You add up all those things just over hundreds of times, and I think you're going to make money if you're doing it right. So managing it, you tend to want to hold it until expiration. If during the life of this call you're doing like 10 different adjustments, you're doing it terribly wrong. Terribly. You want to hold it. I say hold it until expiration and keep that in mind. But, once you get to expiration week, if you can buy the call back for pennies, do that. And if you still like the trade, roll it. Do the same trade again for another 6 months. That's how we actually get and realize annualized returns. So you can either close the entire trade or roll the darn thing. I had John put together an example for me. Oh, this one. I love that John put together this example because this is a trade that I think we actually both have on. I have this on. I actually traded this a few months ago. So Intel's an interesting stock, right? Been a chip maker for a long, long, long time. And like most companies, I mean, let's be honest, right? Most companies They have this growth phase. Then they have this phase where it kind of levels off and they're a nice solid company. And then management rests on their laurels. They hire too many people. Their costs are too high. They don't push their salesmen hard enough. And, the company starts to falter. Well, it's kind of been the life of Intel, right? I mean, 70s and 80s, I think, 90s maybe even. It was such a darling stock. Then it kind of got whatever. And now it's just like bumping along in the 20s. They hired a new CEO a while ago. Maybe to talk about a new one. But it's a different world for chip makers now. And Intel got behind on that revolution. All you really need is somebody to pull their heads out of their butts and say, oh, hey, have you heard of this AI thing? Maybe we should get into that. And you could probably breathe some new life into this company. Should the expiration date? Oh, I'm going to hold that, Howard. That's a great question. Stay tuned for that one. So I kind of like holding this stock long term. But hey, man, if there's one thing I know about the human race, they're great at inserting their heads into their rear ends, but not great at getting them out of them. I don't know. Maybe rear ends are like roach motels. They go in, but they can't come out. I don't know. So, maybe they won't get their heads out. So here's what I like. I actually did a trade similar to this, but I did it a while back when I could have actually I actually did get even more for this. and I actually did the 25 strike, but this is what John came up with. What if I bought the stock, which was at $22.25, and I sold the 24 straight calls at $2.46. Let's check this out. So if I buy 100 shares at $22.25, sell the 24 straight calls at $2.46, what do I got? Well, I can do some pretty easy math on this. $2.46. I barely even need my calculator. I know that that's about 11%, right? Let's see how close I am. 2.46 divided by 22.25. Oh my God, it's 11%. I am so good at arithmetic. I used to be really good at arithmetic. Now I'm not. So I've got 11% cushion to the downside. I did some research on Intel. I personally don't think they're going out of business. I don't know if they will pull said heads out of said butts by December. But I don't think they're going to, fall more than 11%. And if they do, I will gladly buy the stock at a break even of 1979. But what if that darn stock goes up? How much do I make if the stock goes up? Well, it goes from 22.25 to 24. So I make 24 minus 22.25. I make $1.75 on the stock plus 2.46 on the call. I make $4.21 is my maximum profit on this. Divide that by 22.25. That's 19%, 18.9%. Even if Intel figures it out, realizes that there's this whole AI thing going on and jumps into that market and pulls off some miracle where they make better chips than NVIDIA or even comparable chips than NVIDIA or chips that serve a different purpose than NVIDIA and they can sell them. Maybe the stock goes on a tear, goes up to 30, 40. Hey, man, that's okay. I'm still good making 18.9% in how many days was that? 176 days. How many 176 day periods are there in a year? Well, if I make 18.9%, let's multiply that times 365, divide that by 176. That's a 39% annualized return. I'm going to do that all day long. But Dan, if they get into AI chips, I mean, this stock could go up 100%. I don't care. I have to think about this as what's the percentage chance of them creating some chip and the stock going up 100%, and factor that in. If they don't, the stock's not going up 39%, it's going up nothing. If they do, stock goes up 100%. So just creating an oversimplified scenario here could make 0% if Intel just does nothing. Could make 100% if they create some great AI chip. What's the chances by December expiration? Well, or in the next year, say. In the next year. Is it more than a 39% chance of the stock going up 100%? There's where you make your decision. I might throw that in my book. Because I think if this were a binary scenario, it's 0% or 100% over the next year, it's probably less than a 39% chance of it going to 100%. Probably more of a chance of it going to zero, staying at 0 than 100. So the answer is yes, I would love to take 39% and risk missing out on 100%. Again, this assumes that we roll because this is an annualized return. So 176 days from whenever the screenshot was taken, I roll and I do it again. I made a pretty darn good choice here. So Howard asked, should the expiration date be the monthly expiration date? So with long-term buy rates, it's going to be by nature because the weeklies never go out more than 2 months. So these long-term ones, like for long-term buy rates in the regard that we're talking, because these are different animals, aren't they? Like you've seen my presentations for Firstrade on covered calls or with market taker mentoring on covered calls. This is a different animal. It's constructed the same, long stock, short call, but they're done at the same time. They're longer term. And that longer term makes such a big difference. It's not universally better or worse than a short-term covered call. It's situational. So they will always be monthly expirations, which is good because monthly expirations tend to be more liquid. How many stocks is a good amount to do buy rates at the same time? Oh, Howard's asking great question. Actually, everybody's asking great questions today, but I love this one. So you're not going to find 1,000 of these trades. Intel, like this trade, I personally actually like. May or may not be right for your situation, but I personally have on a very similar trade to this. I like it. It fits my needs. On the one hand, I would say as many as you can would be good for these long-term buy rights. But I think you should also think of it as its own asset class. Like you're going to have some growth stocks. You're going to have some uh, value stocks, some dividend stocks, some foreign stocks, some bonds, some commodities, maybe some currencies, maybe some crypto or whatever, maybe some gold or precious metals. This is also an asset class. Why? Because the premium over parity, the time premium, is a function of implied volatility. That's a different asset class than stocks or bonds or commodities. So, I mean, I don't know. I think if I could do this with up to 20% of my portfolio, I would. I haven't found enough to make up 20% of my portfolio. And I don't like to be too concentrated in any one stock because, truth be told, I'm good at fundamental analysis, but I'm not great at fundamental analysis. There are people who are better than me at it. So I have in Intel, it makes up, well, the Intel one makes up a small percentage of my portfolio. But I have others. Yeah, I mean, I would do up to about 20% of my portfolio. And that's because, I mean, honestly, this is something I have expertise in. Like it's weird for somebody to call themselves an expert. It's like when an artist calls himself or herself an artist, like it seems a little trite. So like I don't want to call myself that, but I've been doing it 30 years. And if you do anything for 30 years, you get good at it. And I'm writing a book on it. So for me, because I do have that expertise, yeah, I would do up to about 20, I mean, even up to 25% of my portfolio with it. It's a great trade for the ones that work, for the ones that model out. But I wouldn't have every stock like that. Very, very great question, Howard. Costas says, you take into consideration 52-week high and low when you determine the strikes. I do, because I would not do this with a stock that had 52-week highs or lows very far away from the current stock price. But when I trade these, I trade them different than with short-term covered calls. The short-term covered calls, I trade strikes farther away from the current stock price to give them room to run. These I don't, because I naturally get that room to run with the higher percentage of the stock price. I sell them much, much closer to the money. So the best answer to your question is, if the 52-week high and low are each 50% away from the current stock price or more, I probably wouldn't be doing this. I would do this if the 52-week high or low was, I mean, I don't have a specific rule on this. I do have a lot of specific rules, but just not on for the 52-week high and lows. Maybe a cutoff might, and look, you're going to trade different than me anyway, right? Every single person in the world trades different from any other person in the world. So maybe a good cutoff is if the 52-week high and or low is more than 25% away from the current stock price, maybe it's not a good candidate. I don't know. I'd have to think about it more. Bob, I have a hard stop at 1 p.m. I have a hard stop at 1 p.m. too. Oh my gosh, I got to get off this call. Bob, thank you. Everyone else, thank you. This is something I'm really passionate about. And because of that, don't forget to listen to my podcast, Wealth Building with Options. There's lots and lots of great stuff on any of your favorite podcasting platforms. Just go there. That said, have a great rest of your day. I will see you next week. Alex, I'm glad you showed up today. All right. Madeline, I'm glad you showed up today too. Everybody, thank you. Thank you, Baron. Okay, have a great day. Talk to you later. Bye.